Okay. Well, we're at 12:02, so let's start our power lunch this afternoon. Again, thank you. Welcome. My name is Susan Damiani. I am the director of gift planning, and I'm also the director of the McAllen Society at St. John's University. If you haven't heard of the McAllen Society, or I'm sure if you know me, I speak about it all the time. I've been the director for 21 years here at St. John's, and I'm very proud to be the director of the McAllen Society, which is our legacy society. Very generous alums, parents, friends, faculty, administrators, all have become members of this wonderful society, making a planned gift to the university, which we would not receive until they pass on. So, a lot, the Power Lunch is really focused on financial and estate planning. I know when I first started this job, I thought I knew, you know, a lot, but not as much as I thought. There's a lot that goes into financial and estate planning. We have Meet the Experts, which will be coming up in September. We offer that in person. We also do a version online as part of a power lunch. So really, my job is not only to raise major funds for the school, but also to help our constituent, our St. John's family, learn and educate them in these areas. And what better way to do it than inviting our family to the table who are experts in this area. So let me introduce you to our speakers today. We have John Separano. He is a wealth manager and principal. And he graduated from St. John's University College of Business Administration in 1985. He majored in finance. I always also, I know I have to let everyone know that John was the cheerleader at school. So, but I think that's important to know because he, as a financial advisor, is your cheerleader. He only wants the best for you and to make sure that you are making the best decisions with your portfolio. He provides investment and wealth management advice to high net worth families and individuals, particularly business owners, and he specializes in clients who are actively accumulating their wealth and who are interested not only in preserving what they have gained, but also in continuing to grow their assets with an emphasis on minimizing their taxes. And John has over 25 years of experience in financial planning, taxation as well, business consulting, and financial consulting. So he is going to give us some sound advice in our retirement planning. Also, today, as one of our speakers, you'll see her as well at our Meet the Experts session, is Phyllis Ann Polizzi Kalenka. She's a partner at Spellman Gibbons Polizzi Trunkel. Am I saying that right?
Yeah.
Trunkel and Trinacosta LLP. She began her legal career as an associate in the law office of Spellman and Walsh in 1990. She was admitted to the practice of law in New York State in 1991. So she's been practicing for a good number of years. Her practice concentrates primarily in the areas of trust and estate planning and administration and residential real estate. Phyllis Ann also graduated from St. John's magna cum laude with a Bachelor of Arts degree in Government and Politics and English. She was the secretary of the Skull and Circle Honor Society, a recipient of the Outstanding Student Achievement Medal, and in 1990 she earned a JD from St. John's University School of Law, where she was a St. Thomas More Scholar and Senior Bar of the Moot Court. So I'm putting you in good hands. I hope you learn a lot from this session. If you have questions, which we want you to have questions because everyone can learn from each other, please add that in the chat. And we will answer as we go along. We want to make sure we answer all of your questions. So now I'm going to turn it over to John. Thank you.
Thanks, Susan. It's always fun to be a part of these. Working with the collective knowledge of different professionals that we get exposed to just in our own community at St. John's has been not only helpful for me, but for all parties because we're able to collaborate and help our clients now and in the future by learning. I work with Patricia, who's on the call, work with Phil Sand, I work with others, probably numerous others over the many years. I've been doing these power hours and expert panels for probably close to 20 years now. So Susan, who was a college friend of mine, got a hold of me a number of years ago and said, "How would you like doing this?" And the handcuffs have never come off. So here I am. I really enjoy doing these things though, because I started out as a CPA working in Manhattan for Price Waterhouse, which is basically taking a fiduciary oath to help those people with all of their, accounting and tax and finance needs at that time. Then it morphed into my own CPA firm. And then I sold that off and became a financial planner because I wanted to be able to advise people throughout the whole year on all the aspects that they were asking me just as a CPA. So having that background and getting my master's in tax, it's given me a vantage point that I can help people throughout their whole lives, and trying to help them get to the retirement stage is a natural progression. Everybody eventually starts thinking about, sometimes too late. So hopefully today we can go over a couple of these planning ideas on the different stages of your life. I'll give you my version of the things that should be considered, and we'll get into some technical matters as we go along. So the groundwork in planning to secure retirement starts what I call in 5 phases. I'm going to use a lot of 5s to make this really simple. There's the years that you're working from when you either started a trade or came out of college, or whatever you did to prepare yourself for work up until today, wherever you are. And all of you are probably all different ages. But up until the time that you're about 5 years before you decided to retire, whether that's at 55, you retire at 60, 60, you want to retire at 65, or even older, or you want to, continue working the rest of your life, whatever it is. But if we're going to talk about it from a retirement standpoint, whatever that 5 years is up until that point, there are some things that you need to consider, and we're going to go over those. The next 5 years are the 5 years right before you retire, where you have to make sure that whatever you've done up until that point, you are on course to be able to retire on your terms. That's what's really important. Then there's the first 5 years in retirement, and there's probably for some people a lot of anxiety. Am I spending too much money? Did I accumulate enough money? Do I need to take Social Security? We're going to go over all those things, but there's a little bit of trepidation, a little bit of anxiety. If you're married, the one spouse may be concerned because you never got a hobby, and now you're up there kazoo at home, and you're driving them nuts, and I want to get you out of the house. I'm not there. But my point is, try to think about when you're retiring, what you're going to do, because that's one of the reasons a lot of people push off retirement. It's not just because of money. The next one is right after the first 5 years. Then you have to talk about whatever time frame that is up until the IRS stops mandating things to you. And one of the things that they mandate is that you start taking out required minimum distributions outside of your retirement accounts, whether it's still in a 403B, whether it's in a 401k, whether it's a 457 plan, or whether it's in a simple IRA or any of those things. So that's when the majority of your planning stops from a IRS standpoint, from a major decision standpoint. And then for the rest of your life, what you're really focusing on in many cases is your cash flow, medical considerations, and charitable and gift planning while you're alive and when you pass, if you haven't already done some of these things. And what's really interesting is when I've seen people go from their mid-30s, early 40s, up until the time they've retired over the last 25 years, I've seen them changing their own goals, because you find that different things are more important to you in life at different times in your life. So like everything else, the guarantee is that changes are going to happen to you, sometimes good, sometimes bad, and we'll go over all that. So what I wanted to do is then talk about, in each of these 5 areas, there are 5 areas along the whole time frame or your lifetime that you have to take things into consideration. One is risk management, regardless of your ages, okay? And that's basically all your types of insurance. We'll go over that in detail. Then the next thing is your investment management. Where are you putting money once you've earned it and you have extra from your normal cost of expenditures that, you know, in living life. And you need to be able to control what you can with a long-term plan there. So when I talk about investment, it's not just putting money away for emergencies that come up. It's for the money that you don't anticipate needing. So it's in addition to your checking account, an emergency fund, and then what you're planning on saving for your retirement. With the rare instances, and in some case necessary instances, we may need to pull out of there. And how do you go and do that? The third thing is tax planning. As soon as you start making money, you have to start thinking about how to minimize your taxes. Sometimes you can't. When you first come out of high school or college, you start working, you've got a W-2. You don't own a home yet, maybe. You don't have any deductions. And basically, whatever your wages are, you want to make sure that you have enough taken out to try to basically break even when it comes to tax time. Nobody likes getting sticker shock at around April 15th and being surprised with a big tax bill. And you shouldn't be really, really happy if you're getting a huge refund, because basically you gave the government a loan the whole year that you didn't need to, and they will not be paying you interest. So that's why tax planning is important. And it gets more and more and more important as you progress in your life and your income goes up, and therefore your tax brackets go up along the way. The next thing is retirement income planning, talking about how much money are you going to need to save for you. No two people or couples are the same in terms of their spending patterns and what's important to them. There are people who have a very fulfilling life and live very frugally and are very happy. Others I've seen have a tremendous amount of money and they can blow through it just as quick, or live life in a little bit of fear because they're afraid of somebody taking it away from them. So it goes from one extreme to the other, and we'll talk about that. And then the fifth item is gift, trust, and estate planning. And I did not say estate tax planning, because taxes are just one aspect of estate planning, which I'm going to give Phil's a chance to go over that. And quite frankly, you know, let's start out. I don't want to like go through like 45% or 50% of the session without Phil's having a chance to chime in here. Phyllis, you've seen people who've come into you and want estate tax planning. They find out about you. But in
Absolutely.
many cases, you may have to ask them questions about, well, how much money do you have and you're trying to protect?
Yes.
Well, how much, what's your assets worth? Do you have insurance to protect you if you're so fearful of losing all this? Who you're working with? Do you have a CPA or somebody? And your retirement planning, are you set up for that? And can you give money now, or do you want to? You're charitably inclined. So do you see, like I am saying similarly, because we've worked together on how gift, trust, and estate planning in your role intertwines with a lot of things I'm talking about?
Oh, absolutely. And you know, it's very true that you can set up a plan now, whether it be a financial plan or an estate planning plan of action. But over time, it's going to require adjustments. And I actually like your 5-year theory, because I always tell my clients when we set up an estate plan, I try and encourage them to pull out their documents and review them every now and then. And I say, please don't, at least every 5 years, take your documents out and review them. I said, if not more frequently, because more often than not, if there's going to be a change in the estate tax laws or something, a change in legislation that will affect the plan they put into place, I'll be notifying them about that. But more often than not, what I see is that people's personal circumstances change over time. So someone they might have picked years ago to serve as their executor or as guardian for their kids is no longer someone they maintain a relationship with. And so when you put the time in creating a plan, whether it be a financial retirement plan or an estate plan, you need to tend to that plan as well and devote time to keeping that plan current. Not that you have to constantly worry about it. That's what John, myself, and other professionals in this field are here for, to guide you. But it doesn't make sense to put a plan in motion and never look at it again. And when I meet with people for estate planning purposes, this is something that most people don't realize. What we do is I take time to go through with them and not only compile information about family tree, compile information about their likes or dislikes, but we also create an informal asset summary at our first meeting, which we then develop and refine with the help of input from their financial advisor and their CPA if necessary. And the importance of that is to make sure that the plan that we're putting into place is effective in controlling the assets which they own. I've seen in my estate administration practice the best of plans be frustrated by actions taken by my client years after they put the estate plan in motion, when they've not looked at their documents, or where their financial advisor unfortunately has not recommended that they confer with their attorney when they're putting into place a transfer on death beneficiary designation, or updating any types of account ownership changes. So when you're creating an estate plan, it's always beneficial to you and to your family members and to the people that you want to benefit with this plan to involve not only your attorney, your financial advisor, your accountant in some cases, to ensure that your plan is well-rounded and addresses exactly what you own and accomplishes the goals that you want to establish.
Phyllis, thank you. It's kind of funny. None of the professionals that you should have working for you should be working in a silo. As a matter of fact, one of the first things I do when I meet with anybody, prospective person, and ongoing person, sometimes people move, they move to different areas. We got to establish new relationships, especially when they move states and things like that, going from New York to Florida or wherever, is that they may have to reconnect with another party because they don't have jurisdiction, and they're like attorneys are state by state. CPAs are CPAs around, around the country, but they also, you may want to have somebody versed in state taxes. If they don't have that experience, you want to get somebody who does. So one of the things we are really good at, Phyllis and I, are making sure that we have resources, like even Pat's on the phone here in real estate. So that's how we work. Well, here's my take on the first, on these periods here, and I'll make you laugh with a little bit of my comments here. First of all, the long period, which I said is the first period, your working years, okay, majority of your working years, up to the 5 years before you retire. It's the longest period to plan, but the majority of life-defining decisions are made. Let's go over those, and all you can reminisce on this, we're a little bit, at least 45 or 50 or say. You have to make decisions about working for someone or start a business. You potentially may get married. Those are decisions. Decisions to have kids, how many and when or not. Decision to move for a job, physical attraction, or a life event. Everybody's got a reason why they move. Reason you should have a net worth statement to know where you are at least once a year and gauge whether or not you're making progress or not, so you can make changes or continue on your current path, making sure you have the right insurance levels, make sure that you know what your options are. Decision to save for retirement or play. I've seen people do all this and blow money. Are they going to travel the world? Or when you finally can, you're making these decisions. Determine how you are paying off loans, or wait for the government to forgive them, then get disappointed because they're not. Decision to buy a home or rent. Okay. Decision to pay for childcare if both parents need or want to work. These are all decisions. Decide to have save for kids' college or pay off your student loans first. Which one should you do? One of my old adages is a child could take out a loan for college, but you can't take out a loan for retirement. So you got to find a balance. Decide to switch jobs. You want to move up the ladder somewhere and take a different position. Decide on how much you should have an emergency fund in case your spouse gets laid off for a period of time, or you do if you're single. Decide to buy life insurance, long-term disability. Now you feel cash poor because now you're paying for insurance that you didn't have to before. Decide to hire a CFP like me or some financial person that can help you make sense of all these decisions you're having to make. And they seem to come in silos, but one thing I want to say, and I'll continue on this list, is that you shouldn't be making these decisions in a vacuum, because in many cases, if you make one decision, it has an impact on many other aspects of your planning, okay? Check your Social Security statement along the way. I've had people who filed for many years, my wife's friend up in New York, And she filed, and I asked her back when she was about 40 or 45, I said, do me a favor. She had an injury and she didn't know whether she was going to go on disability. And I said, well, let's start with what your disability is. You need 40 quarters in order to qualify as an individual to be able to receive Social Security, regardless of what the amount is. And when we got it, there was 4 years where she did not get any benefits on her statement. And you're only allowed to go back so many years, I found out, to make corrections. What happened was she filled out a form incorrectly. The employer picked it up as a 0 and it was an 8. And that one digit screwed up her whole crediting. So I recommend that everybody looks at their Social Security statement every year after your taxes have been filed. Wait until like the fall, because that's about the time they get all the records updated, and just make sure that it's accurate. That's all it is. You can go to ssa.gov, establish a username and a password. Don't lose it, because it's a pain in the neck to change it. Otherwise, you're going to wind down sitting in a chair in a Social Security administrative office. It's a pain in the neck. So just have it ready and take a look at it once a year. They used to mail these things out, and then the government got efficient. We got computers, and they started sending it out. So it's easy enough to get on there. Check your, realize at 50 to 55 that retirement isn't that far away. All of a sudden it snuck up on you, right? And you need to catch up. Well, what can you do? And how long will it take to catch up now? And then you have to decide how you're going to help your, you may have to decide how you can help your parents when you're in 50s. All of a sudden they may need help financially or physically. And if you haven't saved enough for you and your kids, now you may need to be worrying about your parents, which they call us the sandwich generation, right? And that could usually mean either physically or financially or both. So it's very stressful for people. The next 5 years are the ones just before you plan for retirement, whatever that age that's going to be. Either you're feeling confident or you need time and encouragement by somebody to get a reality check to see whether you're on course to retire on your terms. I keep saying it, on your terms, and be able to spend the way you want to spend. So you have to know then, what are your sources of income from the outside your own portfolio? Social Security, pensions, rental income if you had bought property and you're renting it, and the rest, if there's a shortfall, it's got to come from your own resources. If those other ones don't cover it all, you may have to fine tune it. You may have to tweak things. We all went through COVID. How many people bought how many subscriptions for Netflix, Prime, this, that area? I encourage everybody, I don't care how much money you have, to go through these things, because we're spending our money in many cases on things we're not even using anymore. So there's ways to cut back on little things. Okay, so the next thing is to, yeah. Now let's talk about the next phase, the 5 years going into retirement now. Now you have to make sure your net worth statement is up to date just at that time to know where you're going to be able to pull from. Make sure you have the right types of insurance. And one of the biggest ones, and please somebody remind me later to go over this, is umbrella insurance, which is personal liability insurance. You may think you have everything covered with car insurance and homeowners insurance, and then God forbid you do the one thing that anybody can do if they're driving a car, is hit somebody and get sued. And the chances are, if it's a person that's making good money, you define whatever that is, above your coverages, you can be sued, and we want to make sure that your assets are protected. So from a moral standpoint, this is St. John's, right? You want to make sure that you're properly, covered to protect the people you hurt, and you also want to protect the people, your own family, from your own mishap, because it's an accident in most cases like this. So next thing is review your insurance coverage to determine what you can lower or drop, just around either just before you retire or right afterwards. We don't need as much life insurance when we go into retirement typically, because we've paid off a lot of our debts. We've raised our kids in most cases, and maybe you've accumulated enough money. There may be reasons to keep it though. You may have a family business that's done very well, and you have an estate tax problem. You may need the life insurance. Then Phyllis, I'll let her talk about, just put this on your little checklist to talk about this, Phyllis, ILITs, Irrevocable Life Insurance Trust. Because I have seen people who have stayed under the estate tax limits have $5 million of life insurance or $10 million of life insurance because they wanted their family to be left well off or not have to pay the taxes from selling their business. And they didn't put the life insurance into an irrevocable life insurance trust, which would keep it outside of your estate. There's other ways you can do this, but I'm using a very simple one. And if you do that, when you pass away, the family gets access to that money, but it's not considered part of your estate, and therefore you don't have to pay estate taxes.
Ron, do you want me to intervene right now or
Yeah,
wait?
we'll go over it right now.
Okay,
Go.
just in a nutshell, a irrevocable life insurance trust is a separate entity that is created under a trust agreement. The theory is that this life insurance trust, once created, will purchase the life insurance policy on your life. And if the trust purchases the policy, the proceeds paid by the policy after you die are not subject to being taxed as part of your estate. However, the trust, in receiving those proceeds of insurance, now has liquid assets which can be used by the trust, can be loaned to your estate if there is an estate tax to be paid for use in paying that tax. Or if your estate assets consist of assets which are not easily liquidated, the life insurance trust can provide funds to pay estate administration expenses until assets can be liquidated. All right. The beauty of it is that, yes, as John said, it can provide a means to provide resources available to your family members, which are not owned by you and therefore not taxed as part of your estate.
Great. Thank you, Phyllis. We love this stuff on the side. We actually get excited about this stuff. We actually have to act professional and very, calm and everything, but this is good stuff. Anyway, next thing is we talked about Social Security, about checking it, but now you may have to make the decision in your first years of retirement when you're going to take the Social Security. So Social Security, taking it is a decision that has many factors that need to be considered. You have to consider your health, your family's history of health. You have to consider your other sources of income. If you're still working, you're obviously not going to want to take Social Security too early if you're making the same amount of income and actually it's growing and growing, because you can put that off until age 70. However, some things you should be aware of, and there's charts out there that I can share with you. But basically, most people, the full retirement age right now is 67. Most people who haven't claimed it yet. And what happens is from 62 to 67, for each year before full retirement age of 67, you're losing per year about, and it goes by month, but on an annual basis, you're losing about 6.5% per year by not waiting until getting to full retirement age. And if you go from full retirement age at 67 to 7 years old, then it goes up to 8% per year. So I can't give guaranteed rates of return like that on an annual basis. If you have other sources of income and you're healthy, most people will probably wait or should wait. But it's a individual by individual decision or family decision based on the facts and circumstances. But it is something that should be considered. Sometimes if you're married, one spouse will take theirs, who maybe made less. The other spouse who's made more, you wait to let that continue to grow. So the facts and circumstances will dictate what's in your best interest, but these are decisions. You need to also look at your asset allocation. We didn't talk about that while you were working, but I would say this in general, and I did this with my own sons. When you're in your 20s and your 30s, you can afford to have anywhere from 80 to 100% in stocks because you have a long time horizon in front of you. When you start to get into your 40s, depending on how much money you've accumulated and amassed, typically what I see people is scale that down a little bit by either 10, 15, or 20%. By the time you get to retirement, depending on how much you've accumulated, you've either accumulated way more than you ever expected or earned, however you want to look at it, okay? And you can maintain this because maybe the first $1 million or $2 million, whatever you may have, is going to cover you for your needs to pull out of the portfolio. It could be even less. But if it goes beyond what you need, and even with an additional buffer of 20, 30, or 40, or 50% within you need, in many cases, clients that I've seen, people, okay, are basically have assets that they're never going to spend. So they actually have assets that they should think about for whatever their purpose is, charitable intent, children, whatever it is. And they could either decide to keep it as conservative as they are, or they can get more aggressive with that part of the portfolio because it's going to go to their kids, which they want to grow, which may live beyond them another 30 years. So if you're in retirement in your 60s, and there's a chance you can live 25 to 30 years or more, and then your children, if they're in good health as well, can live another 25 or 30 years beyond. We're talking about a new time horizon, not just yours, if you've amassed enough money beyond your needs. But these are very personal decisions and questions that you should sit down with people and evaluate. And it will directly be pulling in an estate planning attorney, because we have to design the estate planning documents for avoiding taxes, getting to children and certain either at certain ages, or putting them into trust because they have some inability to manage their finances, whether it's physical or mental, or ism like alcoholism, drug addiction, or whatever. Whatever it is, we're here to help you sort through how to protect those assets, how to grow them based on when the money's going to be needed, and how to pass it on when you pass. Or who, the other thing is who's going to be the fiduciary when you pass? Is it going to be your spouse? Or when the second of you passes, who's going to take on that responsibility? Is it going to be a family member? How old are they? Where do they live? What's their relationship with the person? Or do you have nobody and you have to go to a corporate trustee? There's so many decisions to be made. I couldn't even imagine making them on my own. And quite frankly, my parents made a lot of decisions in the dark, candidly. And it wasn't until I was smart enough in my 30s that they started asking me questions. I think that's when they said I was starting to become a little smarter. Anyway, so looking at your asset allocation is a factor of timing and your tolerance for things going up and down in your portfolio. And then also reevaluate, tighten up on your spending, get rid of things like I said earlier, know what your outside resources are, your pensions. A lot of times people are surprised at what their pensions are, higher or lower. You should be monitoring this along the way, whether you have a civil job, whether you work in corporate America for a large company, like a large law firm or a CPA firm. There are different buckets that you can pull from, and coordinating it not only when to take it, but also with your spouse. Because sometimes these pensions say you can get 100% of the payout, which is the highest payout, but then your spouse would get nothing, and they have to sign off on that, by the way. You can't do that without their signature, he or her. And then you would probably, we'd recommend that you go get some life insurance, because you can die 2 weeks later or something after you start getting your pension and your spouse is left with nothing. So there's a lot of factors to consider there. Determine how often you replace and need cars in travel as you get older. Are you moving to a city? I've seen retirees, in their 60s go, we lived out in suburbia all these years, but now we have the time to go to plays, do this, do that. And you move into cities. Sometimes it's a reverse. So plan on how often you replace vehicles. You're going to just keep it until the warranty runs out, or are you going to use a lease? And is it beneficial to have a lease or not? It all depends on how often you expect to and can afford to change out cars. They're a big expense. And start thinking about planning for fun. I said it earlier, in 5-year increments. Let's not kid ourselves. As soon as you hit around 6 years old, you start noticing things about your body you didn't notice before, okay? And what the reality check is there is this: as you get older, you may not be able to physically do some of the things that you'd like to do on your bucket list later. So I always encourage all the people that are getting towards retirement or starting retirement to think about the most active things they ever wanted to do that they haven't done yet, and do them in 5-year increments, and then just add on 1 extra year and keep doing them, the most important things to you, in those 5-year increments. And of course, this is things that you can afford to do, but think about this, the human side of things, because I see people put things off and then all of a sudden they have some physical ailment, and it's like they spent their whole life saving and they don't get a chance to enjoy it. So that's just my 2 cents there. Then, until you take RMDs, the 4th stage of your life with money here in retirement planning is consider Roth conversions. Soon as you retire, right after you retire, assuming you were making more money and paying in higher tax brackets, you should at least consider, if you have retirement plans, whether or not it's beneficial now or sometime before you take take Medicare, take Social Security, and have to start taking your RMDs. There's 3 stages there that you will have the opportunity to do Roth conversions. You typically have to also consider a couple of other things. Is when you start taking Medicare, whenever that is, all of a sudden you will have to be concerned about the thresholds in which the Medicare tiers start going up because your sources of income on your tax return have gone up. So that should be done by, whether you do it yourself, or you get a person like myself, or somebody who is versed in all of this planning out and the coordination of it, is to make sure that you just don't go over, because once you go into the next tier, whether it's by $1 or not, you're paying an extra 185 or whatever it is every year more for the whole year. Okay, so there's a lot of coordination there. Next is determine if you haven't, when you will begin receiving your Social Security. We went over that. And if you are charitably inclined, this is Susan's dig here, whether it's to St. John's or otherwise, you're inclined, make sure to do so out of your IRAs first if you can. And it makes sense tax-wise. There's some tax projecting that should be done there to determine whether you should do it out of there or not. Because it's become harder and harder to take to itemize your deductions because they made the standard deduction so high. And most retirees don't have a mortgage anymore, in most cases, or it's very low, so the mortgage interest is very low. Their real estate taxes may be high, but right now they're currently capped at $10,000 until they change that you can take. And then you have either medical bills, which I hope you don't have, that are out of pocket, because it's based on 7.5% of your AGI. So for example, if your adjusted gross income on the first page of your tax return is $100,000, you wouldn't be able to get $1 of deduction until your medical bills are over $7,500. I'm using it as a simple math, okay? So if it was $10,000, you'd only get $2,500 there potentially. If you maxed out on real estate taxes at 10, now you're up to 12.5. And then the only other things that you can take there are basically mortgage interest. But if it's very low, let's say $5,000 or not, okay, now you're up to 17.5. And the only way you're going to get over the standard deduction is if you have a substantial amount of charitable deductions, okay? So think about IRAs and their timing when you can get benefits of that. However, when you are 70 and a half years old, you're able to start taking that money out of there unlimited. And when you have to start taking your required minimum distributions, you need to be taking out any charitable monies out of there first, because it's before any taxes have been taxed on the money being distributed out. And you have to do it in that order. You have to take out your charitable deductions early. So a lot of times we've all historically thought about doing our charitable deductions to see how much we can save in taxes in like November and December. The reality is when you get older and you're trying to save money on taxes and you have a required minimum distribution, the time you should be thinking about charitable deductions is in the beginning of the year. If you're giving any money to churches or Susan, McAllen Society, or wherever you're giving it, they're going to be really happy at the beginning of the year anyway. So that ensures that you reduce the amount. So if you had a required minimum distribution of $30,000 a year out of your IRA or retirement accounts, and you paid out 10 or 15,000, it should be one of the first things that come out of your IRA, because that 10 or 15,000 will not be taxed. So I just wanted to emphasize that. Okay. Okay. Let's turn the page here for a second. For most of us, when you first start working, you were the least equipped in knowledge, experience, and ability to make major decisions because you didn't have enough time on your side. But you also had the least amount at risk and the least amount of responsibility to others. So wherever you are, and whatever risks you assume knowingly or unknowingly along the way until you are here today, possibly with a little bit of luck and a lot of hard work, okay, you may have dodged some bullets that you didn't know. That's why professionals can help you stop you from making major decisions. When people ask me, what do I really do for people? And I can give them all the details and get really technical. But at the end of the day, think about kids when they first try to learn how to bowl. They go to a bowling alley, and what's the first thing that they do to give them confidence? They put bumpers in the gutters, right? So I think of people like Phyllis and I as the bumpers. You may bounce around in life, but you're going to keep going forward and you'll hit pins, okay? You may not hit all 10 of them, but you will hit the pins. If you make major mistakes along your way in life because you don't get the proper advice, by the people who are independent and objective to be able to give that advice and not selling you something, then you've increased and enhanced your chance of success to getting to retirement and enjoying retirement. And you'll have the mindset to enjoy it as well. So preparing to secure retirement on your terms means you must establish them first. You have to know what you want. You can't just hope that you get there, okay? What do I want my spending to be like in today's dollars? We can always add inflation and everything else, but say, what do you think it is like today? If you were coming to me and you were 45, that may change at 50 or 55, but you can keep modifying, which is what life's all about. Adapting to change, right? That's Darwin's principle. That's how you survive. So consistently monitoring your progress towards your goals, which may change, like I said. This is why I love when people come into me before they make these major mistakes, so that we can help them go over what their choices are, because a lot of times people don't even know what the choices that they have are, and they can get this advice, okay? And now what I want to do is go over the typical things that are broken down here. Let's talk about insurance. Now, I talked about the stages of life, and now there's different things within those stages or along the whole way where you have to think about it. So I alluded to it before. Property and casualty, that's on your home and your vehicles. If you have assets that are not in retirement accounts, okay, and they are basically in bank accounts or brokerage accounts, they are subject to claims unless they are protected by some other means like an LLC, okay? I'll let Phyllis go into that in 1 second. So what you want to do is, which is why a net worth statement is so important, because what I do is I say, okay, what are the exposed assets, the things that are not retirement accounts? What are the accounts that are in retirement accounts? I don't have to worry about them from a creditor standpoint. And what are their hard assets, things as cars, homes, and any other, physical assets that they have, collections, coins, baseball cards, whatever you may have, okay? Those things are critical to know because they're distinct types of assets that are subject to creditors' claims that we want to try to protect. And then if you have jewelry and things like that, you should be looking on your homeowner's insurance and make sure that you have riders for these things. If you've got collectibles, watches, or jewelry, or whatever it is, because, a safe at your home is as only good as, people not breaking into it, or fire and things like that could damage these things. So take all those things into consideration. The next one is disability, short-term and long-term. In many cases, if you're still working, short-term is covered. Long-term is not in most cases. And if it is, it's an option. You have to pay extra for it. But keep something in mind. When you leave that job and you get older as time progresses, right? Long-term care insurance, if you have some kind of disability that shows up, or you start smoking, or whatever something is that health insurance wants to ding you on, when you're in a group policy, they can't isolate you out. So my recommendation is always to look at some form of long-term disability policy, even if it covers some supplemental amount over time, because if you get hurt in your 30s or 40s, it's easy to die with no money, but it's not easy to live with no money. So to me, long-term disability is very important. I don't sell any insurance. I'm just telling you that it is something, especially while you're working. Now, what I do want to tell you is this. If you are approaching retirement, okay, and within the last 5 years, especially, it has a diminishing return because it stops paying out at 65 unless you get to like 63 or 64, and then it goes up to about 2 years afterwards. So you literally could get it if you got disabled right at the end at 67. But at that point, hopefully you've accumulated enough money anyway. So my point is really reevaluate any long-term disability policies if you have them as soon as you hit around 60 to 62, because the chances are you probably don't need it anymore, but that's a calculation. That's something you've got to go over. The other thing, same thing in life. Life insurance typically, other than people who are trying to, like Phyllis and I were talking about before, have a life insurance policy to cover an estate tax issue. But if it's just for cash needs, chances are by the time you hit 55, 60, your mortgage is down dramatically or gone. Your kids are hopefully out of the house and off the payroll. Okay. And you don't have as much need for life insurance. So you can either diminish it or get rid of it. It all depends on your facts and circumstances. The next one is health and Medicare. Some of you who may work for a job where healthcare is paid afterwards, like if you're in the military, you get TRICARE. But we have to know a lot about a lot. That's why I'm going over all these things, because I get hit with so many questions. But healthcare costs can either go up or go down after you retire, depending on what your age is and whether you're eligible for Medicare or not, and then whether or not you should get supplemental care as well. And then, of course, the last one here would be one like long-term care. Most of the times, I don't recommend people get long-term care when they're too young, because chances are you might not need it. But typical in my field is talking to people around 50 to 55 to start talking about it, because you're probably still healthy enough to get it at a reasonable rate. But it also depends on how much money you've amassed and whether you can self-insure. So these are the kind of things that you really need to be thinking about throughout your whole life. And those needs are going to change throughout your whole life. So it's not static, which is what Phyllis and I were talking about before. Any comments on insurance there, or any thoughts on that, Phyllis?
No, you covered all of the essential areas that people should consider. I've seen it in my practice. I've seen it in my own personal life, the value of disability insurance, the value of long-term care insurance, and also definitely the value of life insurance. In the States, life insurance can provide the resources that a family needs to continue to pay the bills and even just support themselves after a decedent has passed away. Long-term care insurance, if you can afford it, and I would encourage people who are members of groups or unions to investigate the purchase of these policies, because a lot of times unions provide group policies at greater discounts than anyone else can afford to provide. And long-term care insurance is not prevalent, well, not provided by many insurance companies anymore, at least in New York, because the cost of care is so significant. There are a lot of other products out there, life insurance tied to long-term care insurance, which might be suitable for you to investigate. And a lot depends upon, do you have medical issues now? Is there a history of significant issues in your family, medical history, that could potentially, lead to the need for long-term care? And in terms of disability also, I've seen it with so many clients. And my own husband, who was a trial attorney when he was alive, had a fall down a staircase, and as a result of it, suffered a traumatic brain injury, which affected his concentration and his memory. And thank God we had disability insurance, private disability insurance, as well as Social Security disability, but the private disability insurance was much more beneficial. So they're all important factors. Umbrella policies as well. I've seen clients, unfortunately, be sued for ridiculous amounts of money for a car accident or a trip and fall on their sidewalk. And it is, in comparison to the cost of the insurance, it's a no-brainer. It's relatively inconsequential to give yourself peace of mind.
Thank you, Phyllis. And then one other one that I wanted to say, I started the conversation, but I didn't skip over it. I wanted to come back to it. So whatever your personal liability insurance is on your car and your homeowners, what I recommend to virtually everybody, not everybody, but virtually everybody, is that they get umbrella insurance. But you have to evaluate that. That literally is an umbrella that goes over these two policies, homeowners and car, and covers you for things that are in excess of that you could be sued for. And it's one of the cheapest insurances. Every $1 million typically is anywhere from $250 to like $300 for the first million. Then it goes up by another $150 or $200, depending on who your carrier is. But we have policies that we formed as a firm. We don't sell anything, but we collectively bargain for, so to speak. It's not a union, but I mean, we went out and got a company to write this, where they can get $5 million of insurance, for example, for like $1,050. Where if they go out and get it on their own, in many cases, I've seen it being more like $1,500 to $1,600 to $1,700. So these are things that we have access to when you realize how much this can be important for people. And then they go to sleep at night. They're protecting their own family, their own assets, as well as morally protecting other people that they may harm. So it's a big deal.
John, I'm sorry, this is
We're-
Susan. Just to
yes.
step in, we're almost 10 minutes left. I know we have a question about the difference between irrevocable and non-irrevocable. I don't want to mess up your your outline here for today. I don't know if you want to just have maybe while Phyllis Ann was still speaking, to have her just address that and maybe some important documents that people need to safeguard as well,
Well,
especially
let me do
before
this.
retirement into
Yeah.
retirement. Yeah,
The last piece I just want to talk about, because
sure.
it needs to be on everybody's mind the last month and a half anyway, is their investments and stuff. So that'll take less than about 3 minutes, and then
Okay,
Phyllis
great.
can
And then
go.
we'll turn it over to Phyllis. Okay.
Yep. So investment management is another one of the planning topics. Determine your goals for saving. Consider your time frame, your health, your spending patterns. Most importantly, create a budget and monitor it. Okay, so that you know that you're saving towards things. Don't make your savings the last thing or an extra. Make it like a bill. You have to put so much money away. Because I can guarantee we all occasionally go out to eat dinner, go do this, go do that, and everything else. And all of a sudden, an extra $100 or $200 can go out the window really quick in a New York restaurant, almost anywhere you go. So if you want to start saving, you got to be diligent about it. So I would say that. And this is a reality check on your timeline by you looking at your budget and how much you're saving, because it will impact when you can retire on your terms. So you got to be very honest with yourself and look at these things so you know how much you can withdraw and the amount of money that you can take out comfortably without hesitating and spending it. And quite frankly, enjoying the spending. Know how flexible you are and how you are with your spending. When you go into retirement, you have to look at yourself from a personality standpoint. Do I want to know that I can take out so much money per month and never have to change my asset allocation? Well, then you may have a more conservative allocation, therefore a lower withdrawal rate, which means less money. But if you do need it or don't need it is the case, depending on what your budget is. If you are flexible with some of your spending, okay, then you will, thank you, Pat, then you will be able to increase your allocation of stocks, okay? So you don't have to be as conservative. This will help you determine your asset allocation between stock-like and bond-like investments. You have to know the difference between illiquid versus liquid assets and the restrictions on illiquid assets. I get questions all the time. John, should I be in cryptocurrency? Should I be in private equity, private debt, private, anything? There are illiquidity issues with those types of investments, and only a few people should be taking advantage of those, and others should stay clear of those so they don't have to worry about when they have access to those monies, including annuities as well. Understand investment selection and due diligence. There's plenty of products that keep coming out on the market, and they try to always put a spin on it to try to get you enticed to go after it. There have been very few changes on many of these products. They just put in a different wrapper to make it look like they're new, and it hoodwink people into putting their money into it. And in many cases, it's very expensive to get out of, or almost impossible to get out of for a long period of time, 7 years to 10 years in many cases. So control what you can on your investments, which is your fees, your costs, the taxes based on how they invested and how they spit off dividends and interest and in what type of accounts, and then what the short-term risks are. Tax management. Design your portfolios or work with somebody who knows how to design your portfolios to minimize tax consequences. And they have to understand where they're gonna put those types of assets. For the most part, bonds should be in retirement accounts, stocks should be in taxable accounts, and then stocks, for the most part, should be primarily only in Roth accounts, because they have the highest chance of making the most money without paying any kind of tax. So asset placement matters in terms of what type of accounts things should be in. And consider the need or affordability of long-term care insurance, like I said, so that doesn't derail your plan and, quite frankly, derail your spouse's plan, who may be living another 10 or 20 years longer than you. And it could be supplemental, and it is customizable. So you do not need to try to cover every aspect of those costs, because you may have many other sources of income and you don't want to be insurance poor. And then on tax planning, taxable accounts should be monitored for tax loss harvesting. Like right now, this month, all of my clients, I looked to see if there was any losses in anywhere. And basically where there were some losses, we sold it, bought something else that was very comparable to it. You can't buy the same thing back. And what we created was a gift card with the IRS to lower their taxes. So if they had a $5,000 or a $10,000 loss, it was the same loss on the same day I took the loss and reinvested it, and the money is immediately working for them. But we created a gift card with the IRS, so when those gains come back, they're not paying any taxes on it. And most of the financial advisors are not doing that. But the ones that understand taxes and investments are, okay? And working time frame, contribute to retirement plans and types of plans based on your cash flow if you still are working. It's based on what you can afford to put away. And make sure if you can afford it, you're taking advantage of at least whatever the company that you're working for is matching problem is. And know your tax brackets. People should be contributing to Roth accounts if they're working and they're in the 10 to 12% bracket. And then it starts to become more beneficial for most people when you get in the 22% bracket. These are the current brackets, or higher, to get the tax deduction now if you believe you're going to be in a lower bracket when you retire. Business owners, look into all the different types of retirement plans to lower your taxes, including defined benefit plans. A particular one that I'm very fond of and I teach around the country is cash balance plans, because you could make up for a lot of lost time when you're in your 50s or early 60s and sock away a lot of money and reduce your taxes dramatically, okay? Now, right up the alley where we were going here is gift, trust, and estate plan, which are going to turn over to Phyllis. But consider gifting strategies to family members and charities if you're charitably minded and are financially secure. You can't do this if you can't afford it. And depending on the gift level considered, sit down with a financial planner to go over those different types of options. There are foundations you can set up. There's donor advised funds you can set up. You can take money out of IRAs. It all depends on whether you want to keep the principal or want to gift it away when you die, or whether you need the income while you're alive, or that you want to pass it on to heirs. There's so many options there. And for those who need trust, sit down with an estate plan attorney and a financial planner, because not everybody needs a trust. But the ones that do, there are in many cases clear reasons why they'll be beneficial and easier for the beneficiaries and the fiduciaries that you're leaving in charge to take care of those things for the rest of your family when you can't make those decisions. Go ahead, Phyllis.
Okay, so just some basic documents that everyone should consider when you're creating an estate plan. And this is true whether you're a single individual or a married couple. There are at least 4 basic documents everyone should have as part of their estate plan. The first one would be either a will or a will and a trust. And I'll go back to that in a second. The second one would be a power of attorney. Third is a healthcare proxy. And the fourth would be a statement of intent or a living will. Quick summary of each. So a will directs how your assets are going to be distributed after you have died. A trust can be either revocable or irrevocable. The benefit of a revocable trust is that you can revoke or amend it at any time and have full control over the assets in the trust. An irrevocable trust is one which you create and you essentially lose the ability to control the use of the principal of those assets. You would use either a revocable or an irrevocable depending upon what your goal is that you're trying to achieve. Revocable trusts are often used as a mechanism to avoid the need for probate, also as a mechanism to allow for control over assets in the event of incapacity. Irrevocable trusts are most commonly used either to minimize estate tax or to qualify an individual for Medicaid long-term care benefits, okay? In addition to the will or the trust, or will and a trust, sometimes you use both, power of attorney is a document that is in effect while you are alive, which allows someone else to manage your finances in the event you become incapacitated but are still living. Healthcare proxy is a document where you appoint an agent to make healthcare decisions about you in the event you cannot do so for yourself. And lastly, in New York, we call a living will a statement of intent sometimes. It's a written document that essentially expresses your wishes about the receipt of artificial means in the event you are unable to communicate those wishes at a later time. So even the most basic estate plan entails at least those 4 documents. And people sometimes think that those documents are cookie cutter documents, and that is clearly not the case. Those documents need to be tailored to accomplish the goals that you set out, whether those goals be, involve providing for a spouse, providing for a minor or disabled child, or to pursue a charitable purpose. The documents need to be tailored specifically to you. Okay? Susan, I don't know if there are any other questions that we didn't have a chance to address.
Yeah, thank you, Phyllis-Ann. There was a question here about deferred compensation. I don't
John,
know who wants to.
What's the question?
Just can you talk about deferred compensation? I know we're like 1 minute over 1 o'clock, but I'd like to answer that question for
Sure.
that person.
Deferred compensation is basically money that you've earned that is going to be deferred on when you receive it, which most taxpayers are on a cash basis. So they put money aside so that they're not taxed today, they may be taxed later on. The reality, though, about deferred compensation is that it is unsecured. So if the company you work for, God forbid, went bankrupt, you'd lose it all. So that is a horrible thing. So I'm usually not a big fan. And usually if it's built up over a long period of time, by the time they go to take it out, their hope of not being taxed as much could be so large that when they go to take it out, they could be in the same tax bracket, potentially even higher. There are circumstances where you may be able to take out over a certain period of time, but that's going to be based on the type of plan that you have and the way the documentation is set up, the way the plan is designed. So I'm not a big fan of deferred comps other than in certain circumstances, and the stability of the company that's backing, the money that you put aside for you that is otherwise unprotected if something ever happened to the company or creditors make a claim, they get sued.
All right, thank you. Phyllis-Ann and John, I want to thank you for your time and your expertise. This session was recorded. We will be sending you an email with the link and any information. I think, John, you said you had some handouts or something that we might be
I can
including.
always send out, if people send me any questions with, I think we're handing out our email addresses and everything.
Right. Yes, we're going to
I mean,
share
my
that with
firm
everyone.
works on the whole East Coast from Boston down to Florida, so we can help them wherever they're living.
Sure.
And get them information via email. Either way, there's no reason to become a client. I'm just saying, but they can get information.
Just to share the information.
As we
Yeah,
all.
we'll be sharing everything. So look for, at your inbox, look for our follow-up email with all that information. I want to thank everyone for their time. Obviously, this is a lot of information to take in, and that's why we're going to continue to offer these power lunches. The Office of Gift Planning is sponsoring it, just to keep, helping you and guide you with your financial and estate plan. I'm actually going to get a cocktail after this because it was so much information and I'm getting like anxiety filled right now. But like you said, John, if we follow, those 5 steps, and we're mindful, and at least we probably follow maybe 3 of the 5 steps, I'm sure we'll be definitely way ahead than we were when we first started this session. At least I hope so. But
Yeah.
anyway, if you have, sometimes there may be a question that might pop up after we sign off. Again, you can send it to me, or we'll be sharing the information on Phyllis-Ann and John, and you can certainly contact them directly. So thank you again. Till the next Power Lunch. Have a great day.